If you look at the economy right now, credit card debt is at an all-time high at over $1 trillion. The personal savings rate is near decade lows, and real wages just turned negative, meaning adjusted for inflation, people are earning less than they were last year. But if you look at the official government numbers, everything's running smoothly and there is no recession. So the question is, are those numbers accurately representing the economy most people are living in, or are they hiding what's really going on? Now, there's a common belief that a recession just means 2 consecutive quarters of negative GDP growth. But that's not actually how it works. GDP is just one input. What the National Bureau of Economic Research actually looks for is a broad decline across the economy. Things like income, employment, and spending that lasts more than a few months. And they don't follow a fixed formula, and they don't make the call in real time. And that matters a lot because it means that the economy could be weakening, even feeling like a recession, without officially being labeled as one. And when they do make the call, it's almost always after the fact. So most people, they never really find out they're living in a recession while it's happening. They usually find out after it's over. That doesn't mean though that there aren't real signs we could look at to determine whether we're in a recession right now before it's ever officially declared. And one of the best places to start is to look at consumer spending, because consumer spending drives roughly 70% of the American economy. And when consumer spending starts to break down, it's one of the best indicators on the strength of the economy. Right now, credit card debt is at an all-time high at over $1 trillion, the highest balance ever recorded. And it's not just the balance, it's the cost. Interest rates on those cards are over 20%. At the same time, savings are running out. Personal savings rates have fallen to 3.6%, and that's approaching the decade low since 2022. And when savings disappear, debt takes its place. And you could even see it in the data. Defaults are rising and more households are falling behind on payments. But you could also see it in behavior. Roughly 12% of Americans are now using buy now, pay later services on groceries. Not designer clothing or other big purchases, but literally food to eat. And all of this matters because consumer spending may not have collapsed, but it's all being funded through debt. And that's not a signal of a strong economy, especially when people have to go into debt just to afford groceries. Now, here's where the official data can hide how bad things really are. Because on paper, consumer spending is relatively stable compared to last year. But research from the Dallas Federal Reserve found that 20% of earners now account for roughly 57% of consumer spending. And the bottom 80%, which is the vast majority of Americans, account for less than half. And if you compare it year to year, adjusted for inflation, the bottom 80% are spending less and less. That imbalance really exposes how the data can give a false appearance. Because when higher income households keep spending, the data stays strong. GDP holds up, retail numbers look fine, the market stays high, but that strength is concentrated. It's not broad. And that's what creates the disconnect. The economy being measured, the one you see in GDP and spending data, is increasingly the economy of the top 20%. Their spending props up the overall total, and their assets drive up the wealth numbers. Meanwhile, for a majority of Americans, they're seeing the opposite of growth. Their savings are lower than ever before, their debt has increased, and they're not buying assets and they're not invested in the stock market. And this is the paradox. The economy can look stable while most people feel like they're falling behind. Because GDP doesn't distinguish between who's spending the money, only that it's being spent. A dollar spent by a high-income household counts the same as a dollar charged to a person using a credit card at a 20% interest just to cover groceries. Both show up as growth, but they don't represent the same reality. The labor market has its own issues with this, because if you look at the unemployment rate, it's around 4.3%. And on the surface, that looks like a strong labor market. But that number doesn't tell you what's actually happening underneath. The March 2026 jobs report showed about 178,000 jobs added. That sounds solid, but it doesn't take into account the difference between actual jobs and the gig economy. Today, somewhere between 1/3 of the US workforce, over 70 million people, participate in some form of gig or freelance work. But most of that work isn't full-time. In fact, around 70% of gig workers spend less than 5 hours per week on it, and only 1 in 5 rely on it as their main source of income. So someone driving for Uber a few hours a week counts the same in employment data as someone working a full-time job at 40 hours a week. And that distorts the picture, because when people lose stable jobs, a lot of people now, they don't collect unemployment benefits and show up as unemployed on the data. They'll just start doing Lyft or DoorDash or something on the side, and on the official data, they show up as working, even if that work is inconsistent, part-time, or brings in a lot less income than their last job. And you can see the shift happening in real time. Fewer people are switching jobs, hiring is slowing down, and more workers are moving into flexible, short-term, gig-based roles just to bridge the gap. So the unemployment rate stays low, not because the labor market is strong, but because the data is not accurately portraying what's really going on. And if you look at the official numbers right now on inflation, inflation's only around 3%. But that's not really what most Americans are experiencing, because the things that actually matter, housing, food, energy, have risen much faster than that. Take beef, for example. It's up 15% over the year. Now, if that's a staple food in your diet, a 3% inflation cost doesn't accurately represent the cost of how much your grocery bill has gone up. Gas prices are up 18% year over year. And yes, a lot of it is due to recent problems in the Middle East, but that's a big part of your weekly spending, and it affects everything in the economy. And even if you look at housing compared to the 1990s, in the 1990s, the average home price in the US was around $120,000, while average household income was roughly $30,000. That's about 4 times your income to buy a home. Today, average home prices are over $400,000, while average household income is around $75,000. That's more than 5 to 6 times your income. So even if inflation today looks normal on the paper, affordability has fundamentally changed. And you could see the same pattern across everyday life. Groceries, rent, insurance, utilities. The categories people spend the most on have all risen faster than what the official headline inflation number suggests. Because inflation isn't just about how fast prices are rising today, it's about how much higher they already are. And after years of above target inflation, the cost of living is still 30 to 40% higher than it ever was before the pandemic. So when people say the economy feels worse, it's not because they're misunderstanding the data. It's because the data isn't accurately capturing what's really going on.